Hello and welcome everyone to this special online law firms edition of the Dark Money Files Live. We are trying to connect Amy to the call at the moment, but rather than hold everybody up while we face our challenges, we're just going to get going, and Amy can join us as the session proceeds. Let me welcome you formally to the Dark Money Files live online event. Not the first one we've done, but I suspect for many of you, the first one that you've attended. And in this event, we're going to shine a light remotely into a murky world. I'm Ray Blake. With me is my co-host, friend, business partner, Graham Barrow. Hello, Graham.
And hello, Ray.
Bit of an away fixture, this one then.
Well, Ray, that's true. We normally have quite a varied audience of bankers and law enforcement and regulators and so on, but I think this is our first time with a whole bunch of professional enablers.
Graham, I think we feel the same way about that label as most of this group does, and let's not hear it on the call again, please.
No, Ray, you're absolutely right, and that was just a little amusement to kick the thing off. The mere fact that over 100 law firm professionals are interested enough to give up 90 minutes of their time to hear about and talk about anti-money laundering gives a lie to that characterization.
Yeah, absolutely. And you're all most welcome today. I imagine that some people may have come across our podcast, but most won't have.
So let me just say that is the Dark Money Files podcast, which is available via Apple Podcast and all good podcast platforms.
Indeed, Graham, and most of the bad ones too. Let me just do a little introduction before we dive into how this is going to work. So as you can see on the screen, you can submit questions at any time to our producer, George, who's at the other end of the Q&A facility on the live meeting. And at any time during the event, you can log your questions and he'll read as many of those out to us as possible at the end. Amy, Graham and I will discuss your questions, and any follow-up that you've got after the session you can send on to us at one of our emails, which we'll share with you later. The three of us participating in this venture, I'm guessing most of you will need no introduction at all to Amy, who's been a very important figure in anti-money laundering as it affects the legal profession. And that's how we met her, and we were very keen to team up and do something together, because our entire mission is to get people working together to defeat the money launderers, and that's across all sectors of the economy, because so much more can be done. We're going to look at 4 specific sections today. We're going to start with some ideas on how to spot a shell company, the established typologies by which all of the money laundering laundromats that have been brought to light actually work. We're going to look at what a laundromat actually looks like and how those shell companies come into play. We're going to look at how you would identify a laundromat shell if one appeared to you requesting your services. And then we're going to look at the lessons to be learned from the banking sector, potentially, and from others, when we're looking at corporate customer due diligence in the legal environment. So I think we should probably get going with the first topic at this point, Graham. I mean, this topic is an important one, and I think that any law firm that has corporate clients needs to consider some key risks that we're going to highlight this morning.
Ray, I completely agree. In our work, we've looked at the operation of these laundromats, and we've helped banks understand what they need to be looking for. Because for them, it's about making sure they don't let the bad guys through the door, and if they do, they catch them through their ongoing monitoring programs.
Yeah, absolutely. But for the banks and for you guys, there are red flags that you can use to keep them out in the first place, which is going to be way more effective. Shall we work through a few of those, Graham?
I think we should.
Okie dokie. Well, I think we can look at 4 in particular, and we probably start most effectively with the number of data corrections in the record, don't we, Graham?
We do, Ray, and it can be a real giveaway. I spend far too much of my time in the bowels of Companies House, and when you look at Companies House records for some companies, you'll find almost a revolving door, sucking in and spitting out directors, often the same people coming and going multiple times, even when the company may have been purportedly dormant, which is it's weird. Things like amended accounts, changing dates of birth, multiple addresses, particularly registered addresses, it all paints a picture.
Yeah, absolutely right. So next we've got meaningless company names, right?
Yeah, this is one of those dull moments, isn't it? I mean, look, if you're setting up a business, you generally want the business name to convey some meaning. I mean, whether that's because it's named after the founder or a member of the founder's family, like Marks and Spencer, or named for something that it does, like Kentucky Fried Chicken or Poundland.
Yeah, absolutely. Now, in the laundromats, we're convinced, aren't we, Graham, that the bad guys build up company names from an algorithm because there are just too many to come up with a new one each time. These companies have 2-word names. The first will be made up from 2 halves drawn from a pool of short words.
Yeah, like Lex or Lux or Berg or Borg or Mark or Bridge and a few others we could name.
Absolutely. So combine any 2 and you'll get words like Lexberg, Bridgemark, Bergmark, and so on.
Yeah, and then the second one will be some bland, non-descriptive word like networks or systems or associates or trading.
So put them together and you've got company names that tell you nothing about what those companies do. Luxembourg Systems, Bridgemark Trading, or Bergmark Associates, say.
Yeah, that is highly indicative of a shell company, isn't it?
It really is. These people don't want to tie themselves to the company name as it's an unnecessary risk. They might want at some point to distance themselves from the company, and having their name incorporated into the company name is going to make that quite difficult.
It is. So if you find a company that, let's say, called Doreen Davis Direct Deliveries Limited, and its sole director and PSC, that's person with significant control, is called Doreen Davis,
well, then you can pretty much guarantee that it's completely above board, or perhaps that it's the best double bluff you've ever come across.
Yeah. And then, Ray, there's diverse geographical ownership and control.
Yes. Now, I know you follow the fortunes of an Indian lady director called Hema Naronha, who is a great source of such companies, isn't she?
Well, yes, she is. And can I offer you, by way of example, Delta Crown, which kind of meets our previous description, Sales Limited, who in their life have had 6 offices, 5 resignations. Let's just have a look through, Ray. Let's just take us through that list.
Okay, well, at the moment we can see Hema herself, of course, but also we have Stairwell International Limited.
Yeah, in the lovely Caribbean island of Nevis.
Oh, what a marvellous place.
Marvellous.
We also have the wonderfully named Latvian living in Ireland, Danny Banger.
And that really is his name.
Yeah, it is. We have Junchun Lee of South Korea, obviously.
Of course.
As well as Finel Limited.
From Cyprus.
Cyprus, as it says there.
So good. So good. They named it.
Indeed. And then Trendmax Inc.
Dominica, not to be confused, of course, with the Dominican Republic, different place.
No, Graham. This is the Commonwealth of Dominica.
It absolutely is, and this is Rosso Valley, home, has to be said, to probably more companies than people. But
well, yeah, there's that. I mean, Hema, bless her, does get around, doesn't she?
She does, and don't think that's a one-off, Ray, because I think I've probably tracked at least 150 companies registered here in the UK, of which she has or is currently a director.
And I bet her annual general meetings are quite interesting, and I've no idea what language they could possibly be conducted in.
Well, no, and the airfares, well, not at the moment, but once you can fly again, the airfares for those AGMs will be expensive, wouldn't they? Yeah.
A little bit, yeah. I mean, Hema could sustain several episodes of our podcast all by herself, probably, couldn't she?
Probably one day will.
Yes, that could happen.
So, Ray, our final red flag for shell companies.
Yeah, absolutely. Well, our final red flag is lack of web presence, because real businesses rarely seek anonymity. They want to be known, recommended, easy to find.
Yeah, that's true, isn't it? I can't actually think of a legitimate business that doesn't want anyone to know about it. I mean, most of them pay money to get themselves and their names out there.
They do, Graham. I'd say that a real business can't afford not to have a website.
And yet, very few of these shell businesses have any web presence at all. And we're not just talking about a company website here. These entities often aren't mentioned anywhere on the web, or at least nowhere on the surface web.
Yeah, I think if I was onboarding a business and the account opening form left the website address blank, I'd be asking questions.
Yeah, sadly, Ray, I think you'd be in a majority with, in the current climate, because most banks are concerned, as far as most banks are concerned, and checking the register for multiple data changes and recognising international ownership or control either shouldn't be that difficult, but it isn't routinely done as a control in most organisations.
No, absolutely. And I just realised I'd blanked the screen there for a moment.
Oh,
I'm sorry about that.
I thought I was having a stroke. Right?
I wouldn't put it past you, Graham.
Well, no.
I mean, these shell company red flags appear again and again in the laundromats and other shady activity. If it weren't such a dreadful cliche, Graham, I'd introduce the concept of rocket science at this point.
And knowing you, Ray, you'd probably quite enjoy the discussion. But here we come to the crux of this part of the presentation. It is really easy for bad actors to abuse the UK companies regime to create shell companies to further their dark money activities.
But why should that be, Graham?
Because it's been actively encouraged by this government, Ray.
Okay, what has shady dealings with bad actors?
Well, no, obviously, but the government does want people to be able to start businesses in the UK really easily and quickly. Excuse me, it's supposed to generate UK earnings and economic growth.
But a company that's established here in the UK needs no physical presence here and need not be owned here. In all the laundromats, it's overseas criminals owning and controlling these companies.
Yes, because what they like is that it's easy to set up a company here, do it online. It takes no time at all. And a UK entity has the impression of probity and they get recognisable formats like limited and LLP. Nobody looks twice at a company with those suffixes incorporated here in the UK.
No, absolutely. And the fact that they're searchable in an internationally accessible open register gives the impression that they're above board.
So, how many of the organisations that, you guys deal with actively look at onboarding for all of those red flags? I
mean, it's an interesting question because those red flags are highly indicative of firms to set up and engage in known and proven money laundering schemes.
Yeah, I'm not sure we'd want to let these through the door without so much as a second glance.
But Graham, assuming they have come through the door, I reckon, well, banks at least can identify them quite easily from their transactional activity. Yes,
I think they would, but law firms won't necessarily have access to companies' transactional records. But if they do...
Well, yeah, if they do. Look, before we go any further, what we haven't really done yet is look at the big picture, Graham, and ask the question, what does a global laundromat look like? And we're able to do that because of an American court document that gives us a view of what a laundromat looks like. Should we show it?
Go on, Ray, put it up on the screen.
There it is. It looks like this.
It's complex, and clearly you won't be able to read the fine print here. But the grey bit just below and right of centre is Estonia, and that actually is the activity that went through Danske Bank Estonia, which is what we have particularly researched, and we spent a lot of time on our podcast talking about. But this is just the Magnitsky flows, which I know you will explain in a minute, Ray. And they were only 0.1% of the flow value that passed through Danske Bank Estonia. So all of those lines connecting together is a tiny fraction of what actually happened.
Yeah, absolutely. And as you say, Graham, this was specifically the money that was flowing through in what we call the Magnitsky flows. Now, for those who don't know, Sergei Magnitsky was the accountant who uncovered and investigated the theft of tax revenues reclaimed from the Russian authorities and diverted from Bill Browder's Hermitage Fund companies. Sergei Magnitsky died while in Russian custody in what I think we can call suspicious circumstances.
I think for legal jeopardy, that's as far as we ought to go. And that is right, Ray. And it's a very, very sorry tale.
Including his posthumous conviction, which certainly set a precedent for me. So, look, we've been given access to the bank account statements for one of those companies that's on screen there, specifically this one.
Which, as you'll notice, is a UK legal entity, which means you can find details on this company that was in Danske Bank in Estonia at company's house, and no expense spared here because it cost us £1, because it's not one of the free ones.
Yeah, we can share some of that detail with you today. I've gone the wrong way. Oh, that's dear. Right. So here, for instance, is its company filing history, and the dates here are fairly instructive. It's set up right at the end of June 2007, and by the middle of February 2010 it's been struck off and dissolved. Now that whole process that results in it being struck off and dissolved started some time earlier, so the period of actual activity of this company was a relatively short one.
Yeah, it would have been little more than a year, because it's 15 months really, that strike off process from start to end. So yeah.
So it wasn't going for terribly long, but we do know something else about it.
Yeah. So in our world, Ray, they're known as Stan and Eric. Aren't they? Stan Gorin and Eric Vanagels. They are Latvian, but that doesn't appear to be where they are, does it?
No, they're signing on behalf of entities based in the British Virgin Islands.
Of course they are.
And the company itself does set up in industrial activity at that address there, according to its bank, which is in Moscow.
Yeah, I'm going to have a go at that. So that's Yaroslavskaya. Oh,
that's excellent. Well done.
Because I've been practicing.
That's really, really very good indeed. So let's think about this for a moment. This company and companies like it aren't banking in UK institutions, although they are UK registered entities. How are we exposed to them?
Well, I think a couple of ways, Ray. One is because these people like to get their money here. So correspondent banking is one way. So correspondent banks are where small banks in other parts of the world don't have the facilities to do major international transactions, and will use a big correspondent bank. So UK correspondent banks could certainly be used. And of course, the other thing is counterparty payments. So this money has to go somewhere, and we know from the bank statements that some of it came here.
Yeah, absolutely right. Absolutely. So we've got coming back to this case, a UK entity that's operating in Moscow. It's controlled by two Latvians from the British Virgin Islands. So naturally, they're going to want to go and open a bank account in
Tallinn, in Estonia.
Well, of course, of course. So this is their opening statement on that bank account in a surprising place. These are the first credits. Now, this business has no website. It's got no online presence at all. It's a Russian company using a UK entity banking in Estonia.
So I think we need to take a closer look, don't you, Ray?
Mm.
And like magic, look at that. So there are two opening transfers into this is the US dollar account. Two opening credits on the same day. One for just under $1 million and then just under $500,000, but they're both coming from the same source on the same day, and apparently for industrial equipment.
Yeah, or something approximating it.
Yeah.
Some of the typing isn't exemplary, is it?
No.
Where's it coming in from, Graham?
Well, we know from the bits that we've highlighted in yellow that this is what's known as the beneficiary account identifier, which is used in Russia. So that money is coming in from Moscow.
Right.
And you might wonder, Ray, why are they sending it in two chunks and not just one?
Yeah, because it's happening on the same day. These could be minutes or seconds apart. Why are they doing that? But actually, if you spend a lot of time with accounts like this, I think you can work out why. It looks like someone's trying to stay under the trigger points for scrutiny by the bank.
Yeah, I think that's not a bad shout, actually. So should we have a look at where the money's going to?
Yeah, let's.
So this is on the same day. So the money coming in two chunks, and the same day it's going out again. And as you'll see, it's going out in rather nice round figure amounts: 100,000, 200,000, 300,000. One odd one. We'll come to that in a minute. But the interesting thing here is they're all going to UK LLPs, and again we've highlighted in yellow the bank numbers of these accounts, and every one of those is also in Danske Bank in Estonia.
And I mean, I see these are round numbers for the most part, not just below a round number. Why is that?
Well, because they are transfers within the branch, Ray, and to the best of our knowledge, inter-branch transfers are not subject to transaction monitoring. So there are no things to worry about if you're just moving money between accounts in the same branch. Okay,
so here in total is what's happened right at the bottom there at the end of the first day. Nearly $1.5 million in, nearly $1.5 million out, leaving a minimal overnight balance.
And do you reckon that explains the 344,000? Right?
Yeah, could do, couldn't it?
Because they didn't have enough to do a round figure, and they didn't want to do 340 because that would have left a bit too much in the account.
I think we'll see that again as a recurring pattern. Okay, so let's look at the end of day two, which looks very familiar again. Very similar pattern.
It does, and the money's come in from the same. Oh no, it's come in from a different source this time, hasn't it? Yeah, it's on own account. But the money comes in, and pretty much the same amount that's just gone out again.
So yeah, I mean, we've got hundreds of pages of this, haven't we, Graham?
We have, Ray. Thousands, actually, thousands of pages, and it's we've just got 6 of the 10,000 accounts.
So it's the same story every day.
Yeah.
Do you want to run through the things that you never see?
Wages.
Yeah. Profit taking.
Rent.
Reserves.
Yeah.
Drawings.
Yeah.
Everything's paid out to other companies, and it all looks like commercial transactions, and there's still no web presence. And the big question is, what real business works like this?
Well, Ray, none that I know of, or frankly, none that I can actually imagine.
Absolutely. It's not just one account. There's a Euro account too. Let's have a look at that one.
Opening day again. Hey, look at that.
That doesn't look like a Russian inflow, though.
Well, no, Ray, this is where we can put our little geeky hats on, because we did some research on this, didn't we? And we found after much effort that RNN number is actually a Kazakh tax identifier, which is always a prerequisite for foreign companies.
That's easy for you to say.
Wasn't. It really, really wasn't. A prerequisite for foreign companies who open a bank account in Kazakhstan. Thank you so much. I never thought I'd be congratulated for saying prerequisite. Being old is a sad thing, isn't it?
Yeah.
So when you get your tax identifier in Kazakhstan, it then just does double duty for your bank account transfer identifier.
Okay, so this money is coming in from Kazakhstan then, basically.
Yeah, that's just one more to add to the geography lesson. Yeah.
Okay, fantastic. Right, so when that money starts going out of the euro account this time, it's to familiar places with familiar misspellings.
Yeah, more NLPs in the same branch with, as you say, the same rather odd
misspellings. Indeed. Yeah. So lots of that. So let's fast forward to the end of the first week, and I think we'll find something familiar here. So the only one there that's not a round number is 379k. It's the same thing going on again, isn't it?
Well, I think so. Isn't that sad that they're not even prepared to leave a few thousand in there? It's got every flipping penny, except we don't deal in less than 1,000. It's kind of, I don't know.
Yeah. So basically, they were really keen not to maintain much of an overnight balance.
I think that's absolutely spot on, Ray. And bearing in mind that still no internet presence, still no debits, so that doesn't have any debits for wages or anything else. It's just the same in both accounts, money in, money out. That's it.
Absolutely. So when we look at the history of the euro account overall, there's the total activity in that account: 283 million euro, and a few 100,000 as well on top. And all of that, all of that in less than 14 months.
That's lovely.
As you say, still no internet presence, none of the debits during that 14-month period, excuse me, for wages or rent or anything else you'd expect if this were a real business.
Yeah.
Looking at the different currencies, we've seen the US dollars and the euros, but there were other currencies as well. There were Swiss francs, there were rubles, there were pounds also. That's a grand total of...
I'm not even sure I can say that without getting wrong.
$1.2 billion.
That's good enough for me. Never enough. Yeah.
So I think we should pause for a moment and consider the scale here, Graham. I mean, I get very blasé about big numbers. A million is big enough that 10 million or even a billion doesn't seem like too much more to me. But this might help sort that out if you're in a similar boat. So if you were to start counting at the rate of one number every second, 1, 2, 3, and so on, and you could keep going at that pace without stopping for meals or for sleep, or even for toilet breaks, as long as you can keep counting. I'll let you have toilet breaks, Graham.
Okay, but I'm not very good at multitasking, if I'm honest.
Okay, probably best not then. Just keep counting.
Okay.
And if you were to start counting now, you'd reach the number 1 million in 11.5 days. And if you keep counting beyond that, eventually you'll reach a billion.
Eventually?
Yeah, it will take you a little over 31 years.
So let me just make sure I got that right. 11.5 days roughly for a million.
Yep.
And keep going at the same speed, and it's 31 years until you get to a billion.
Yeah, a little over 31 years, in fact. You'll be bursting by then, Graham.
Do you know, I'm going to be honest here, Ray. Knowing how old I am, I will actually be dead. And I'm okay with that sort. It's fine.
Well, you'll have brought it on yourself.
It's if I haven't peed for that time, I will definitely be dead. I
At
think we should.
1.2 billion, I think we can conclude. We'll get out of the lavatory now. I think we can
I think
conclude that's a large sum of money for one company to put through its account in one laundromat in the space of 14 months.
Yes, and just need to make the point that was just one company, albeit one of the bigger ones, in one laundromat.
Yeah, absolutely right.
So, Ray, that's a really good example, but we need to derive some red flags from it, things that we can apply generally, things we can see in the bank accounts that are indicative of laundromat or just generally money laundering.
Yeah, as you say, red flags. And we've got 6 of those. 6 things we can see in the bank accounts that are highly indicative of money laundering or laundromat use. And if you have access to a company's bank accounts or financial records, there are some very, very simple review points. Where shall we start, Graham?
Well, let's start with total volume, Ray. We'd be looking to see if the volume of transactions is typical for the type and age of the business. For example, if it's a long-established building contractor, there will be a typical level of transactional activity, which will look different from, let's say, a newly formed computer consultancy. Now, I can't say that there are hard and fast rules here, but as a rule of thumb, a new business, obviously not the one we've just seen, but a new business is likely to have fewer account activities than a well-established and successful one. So as a general measure, it's a good way of taking stock of that business activity.
Sure. So next we've got daily volumes. So again, this is something of a general measure to see if the business is transacting on a consistent daily basis or if it's more unpredictable. For example, a retail business is more likely to have regular payments both in and out, even though it may vary by season or even day of the week, depending on the retailer. Now, contrast that with, say, a management consultancy, which may be much more ad hoc. They may not bill every day or even every week. As before, this isn't a specific measure that you can just look at and ascertain immediately whether there's evidence of money laundering. It's just to get a sense of whether the overall activity is indicative of what one would expect or not.
Absolutely. And then this is where it gets a bit more interesting. Now, self-evidently, a successful business should take in more than it takes out. Unless it's running at a loss, and then it clearly isn't particularly successful. And that means you would expect that the amount you receive by way of invoices should be more than the amount you pay out in invoices, assuming it's a trading account. Now, the difference would be made up of your other business expenses and rent and wages and other costs, leaving you, hopefully, with something that we call a profit.
Yeah, so one of the hallmarks of a laundromat scheme is the rapid movement of funds into and out of an account. After all, you don't want to risk your money getting frozen in an account if you happen to get spotted. So the idea is to move it on as soon as possible. Evenly matched debits and credits would be unusual for a real business, but absolutely typical for money laundering.
It absolutely is. And then we look for amounts consistently just below a threshold, like 9,000 or 99,000, or frankly, as we've just seen, 990,000. Banks often have limits at which their alerts kick in. Now, some of those, and I'm sure you know, everybody, are prescribed by law, but others are simply based on the bank's own risk appetite. Now, of course, if the launderers have got someone on the inside, they may be well aware of those limits and consistently pay in just below. Or they might have guessed the likely limits or even arrived at them through trial and error in accounts that they set up specifically to test what gets through and what doesn't.
I mean, round figure amounts are quite important too. It's an astonishing fact, but very often money launderers are just plain lazy and move money around the system in big round figures. And if you look at the average honest business account, these figures, except maybe when partners or owners take drawings from the company are really quite rare.
Yeah, the consistent appearance of round figures on a bank statement, unless there are really good reasons from a business point of view for them to appear, are highly suggestive of money laundering.
Absolutely. So moving on, the fifth red flag that we've got. Oh, let me get that up on screen. Doesn't want to go on screen. There it is. Payment remitters and beneficiaries, Graham. So firstly, is there any obvious connection between the remitters, the account in question, and the receivers? So if the account is being used for money laundering, especially as part of the layering stage of the operation, where we start moving things around in a complex manner, it follows that all three elements of the transaction, the remitter, the account holder, and the onward receiver, all have to be under the control of the launderers, because otherwise they've lost the money. They ought to go out of their way to mask those connections, and it's the job of the investigator to find them.
Yeah, and that takes us back to that diagram we saw earlier, doesn't it? The complexity of that operation. And then there's the nature of the business that each of these elements conduct. Now, obviously, you would not expect a fine art company to be doing business with the manufacturer of, say, parts for a motor car, or at least you wouldn't expect it on a regular basis. The motor car parts manufacturer might decide to buy a painting for the boardroom, but you get my drift.
Well, yeah, and then again, you wouldn't expect a firm that's consistently paid by you to consistently send you money. By which I mean you have firms that you pay, like suppliers, and firms who pay you, like customers. And normally they're different groups of people. I mean, it's possible, I guess, you'd both send and receive money from the same company sometimes, but it really, really wouldn't be common.
No. And it's not just the individual sums that move in and out in quick succession. If you do that consistently across the entire account activity, the overnight balance will be very low in comparison to the overall total activity. That is a useful ratio to look at. A regular customer will usually not virtually empty a very active account overnight every single day, but a money launderer very often will.
So there you go, 6 red flags to look at in the transactional activity if you have sight of it.
Yeah, now remember, we're not likely to see laundromat entities banking here in the UK. So this exposure will be at branch or overseas subsidiary level. You'd expect to see overseas accounts here.
Yeah, I mean, that's absolutely worth bearing in mind, but I suspect that many of the people on the call have got experience of offering legal services, which have customers outside of the country.
Absolutely, and we know from looking at statements that lots of companies located elsewhere do business here in the UK, so we still have that exposure.
We are a net exporter of legal services, thank goodness. And when you add those transactional red flags to the onboarding red flags, the 4 that we drew out before, we've got a well-proven set of indicators that, in our experience, a number of banks and most other firms who aren't banks are not routinely looking for.
No, and that seems a bit bonkers, doesn't it? I'm sure our listeners will remember some years ago that the madman, frankly, who tried to get on a plane got on a plane, in fact, with a bomb in his shoe.
I'm sure they'll remember that.
And the same day it happened, the same day, they started making all of us take our shoes off at the airport. But here we are, years after the laundromat typologies emerged, and many firms still aren't looking for them.
It's like we're just waving through shoe bombers.
It's a depressing thought, isn't it?
It is a depressing thought. And on that point, we probably would find this a useful time to pick up on the lessons for corporate customer due diligence that law firms can learn from the banks.
Yes, and I see poor old Amy has had some challenges because she's in, but she's as an attendee rather than as a presenter, and that's going to stop her talking to us.
Okay, right. So here's what we're going to do then. Amy, you you probably need to leave as an attendee and try and get back in through the meeting invitation that I sent you. That should make you a presenter. We'll also try and get George, our producer, to try and promote you to a presenter of the event, if that's possible to do. And hopefully you'll be able to join us fairly quickly. And if you do, come in and please interrupt us talking. But in the meantime, we're going to have a go at covering your slides. And of course, because we've rehearsed this and because we know each other reasonably well, I think this is something we can probably have a good go at, Graham.
Oh, well, let's do that, Ray. We can have a go.
Won't be quite as good as Amy, but we'll do our best.
We certainly will.
So what are the lessons that you can learn from this whole laundromat piece when you're looking at undertaking corporate client due diligence in a law firm context? Well, three main pieces of observation or things that you might want to think about. Now, the first of those is that we have often seen, and by we I mean mostly Amy, but we've spent a fair bit of time with Amy, so I think we've got a fairly good handle on this. And what we see is a tick box approach to onboarding. Certainly not unique to law firms. There's plenty of banks that have the same thing, Graham, would you say?
Absolutely. It's really hard, Ray, is it not, to not, when you start having a process, is not to reduce that process to exactly that, a tick box approach.
It's a fine line to walk, and very few people are walking it correctly as things stand at the moment. The second issue that seems to be relatively problematic, or where there seem to be common difficulties, is the investigation into source of funds and source of wealth. Again, something that isn't unique to law firms, but Graham, might be worth just very quickly talking about the difference between the two before we go on.
It is, and oddly, I'm going to be doing a conference next week on this subject, and I'd have to say, Ray, I'm sure you'd agree that it's probably the area that banks struggle with most. I'm sure it's one that the lawyers struggle with a lot. So source of funds, I always break that down into two elements. One is physically, where did the money come from, and also what activity generated the funds that you're receiving. And you might know that as origin of funds and source of funds, but traditionally in the legislation it just talks about source of funds. So that specifically relates to whatever property, and it doesn't just mean cash, it just means whatever property that you are handling, where did it come from? And then source of wealth is a much more general question, which is, how did you become wealthy? So that is, what was your journey in life from not having wealth to having wealth? Now, of course, that could have been an instant one because a member of your family has just died and you've inherited a whole load of money. Or it could have been a much slower one of a journey from building up a business or whatever. But you have to understand that journey. And I see, Ray, and I hope you have too, we have been joined by Amy.
We have been joined by Amy, but you know what, Graham? I'm enjoying this so much, I'm tempted to leave her muted just while we finish this slide.
I don't think she's going to let us.
Amy, thank you for joining us.
It's lovely to hear your voice.
Goodness me, I'm so sorry for the problems we've had. And I thought you were doing a fantastic job of covering my bit there, so you can crack on if you like.
Well, I tell you, a logical handover might be at the end of this slide. So why don't we
you carry on this bit? Yeah.
Okay, fabulous. So, so the final point here that we wanted to cover was about ongoing monitoring. And I know Amy is going to have quite a bit to say about this, because in our experience, and again, it's not unique to law firms, but 99% of most firms onboarding anti-money laundering CDD efforts happen at the point the client first enters the organization. And unfortunately, that's not where we're able to catch most of the bad guys. They're ever so good at initially getting into the organisation. It's what they then subsequently do that more often than not is what's going to get us into trouble. And our only defence against that is a proper programme of ongoing monitoring. So I'm going to hand over to somebody who's far more qualified to talk about this in a legal environment than me. Amy, hello.
Thanks, guys, and I'm so sorry for not being at the beginning. I had a fantastic introduction written. It
was brilliant.
I told you how excited.
Save it till the end, and you can do it again. That's fine.
Perfect. Okay. Well, so thanks for bearing with me with the technical issues. I mean, this session, I was so excited to be able to put this session on because I hope those of you that are from law firms have picked up so far some of the things that I think that we can learn from banking. And as Graham and Ray have just covered my first slide, talking about the three main themes that I thought that you could take what we've learned already in this session into your policies and procedures. So looking first of all at the tick box approach to compliance and onboarding. I mean, when I speak to people in law firms about onboarding their clients, most of the AML activity is at the very beginning, and it's got to be like that. Obviously, we've got Regulation 30 that requires you to carry out your client due diligence before you establish a business relationship. But when we talk to lawyers, fee earners, people that are rushing to get on with the work that they've been instructed to do, especially if it's got some sort of time critical element to it, they can often find the process of AML at the very beginning to be a hurdle to get through, a process to endure, and sometimes that can lead to people just ticking boxes on the file opening risk assessment or getting a standard list of documents that are contained in your policy and procedure without really engaging in it. And I think what I would say about that is the onboarding risk assessment, of course, you've got to have one. You've got to have one for client onboarding. And since the 2017 money laundering regulations, you need to have one for matter risk assessments. I know that some firms are still working their way through what does a matter one look like and how is that different? And do we go through the whole process again? There are some things that I would say. Where you have a risk assessment that has a lot of boxes, a lot of yes/no answers, if you're incorporating some technology solution like an InTap or something like that, I think it's you need to be careful to make sure people are not just ticking yes all the way down. Sometimes when or no all the way down, or whichever it is. What's interesting to me when I'm out auditing law firms is that sometimes I'll be looking at files and I'll see a risk assessment filled in exactly the same way with a different risk attributed at the bottom. That says to me that there's some difficulty that the lawyers are having, or whoever's filling the risk assessment in making an accurate risk assessment. So the other thing I would say about onboarding risk assessments is that sometimes I see questions on them that can't actually be answered at that stage. So if you're doing your risk assessment in order to determine the amount of client due diligence activity that you're going to do, how many bits of paper, how far you're going to go, who you're going to investigate in terms of ownership, if you're using that risk assessment to make a simplified, standard or enhanced due diligence risk assessment, it's going to drive you to get some documentation. Part of that documentation will be the kinds of things we've looked at today in terms of company's house information. And when you look at that, you're going to want to record your assessment of risk once you've looked at the documents, especially bearing in mind what you've learned today. So the point I'd like to make is that often these risk assessments are finished and signed off before you actually get any of the documentation for CDD. And specifically, we'll look at in a minute, we'll come on to source of funds, source of wealth. These onboarding risk assessments have got questions about that you might not actually be in a position to make. And so the point really is making sure that your risk assessment isn't just a one-off activity in order to get a file number, but it is something that goes through the case. I'll come back onto that when we look at wealth and funds and ongoing monitoring in a second. Now, the standard request for documents, if you've joined today's webinar as a result of an email from me, you'll know I tell a story about a money laundering reporting officer, true story, who was a corporate lawyer. And I asked him, do you actually look at the documents that we send you? And he said to me rather honestly, no, we never did look at the documents. We just thought it was having the documents that was the thing. But of course, that's not the thing. If the documents are on your file, you need to make sure you've read it. And so making sure that the lawyers do read and engage with it. And the reason for that, I'm sure many of you will know, is that the lawyers are the only ones that have spoken to the client often. That what you're looking to do with these documents is look at what the documents are telling you, look at what the client told you, and see if that matches up. That can't be done by CDD analysts often unless they've got that kind of information from the fee earners. So the fee earners have got to read the documents and got to think about what documents are appropriate, rather than just saying, oh yeah, well, I've got all the incorporation documents, that's me, I'll move on. And then, as I say, the last thing is making sure that we've explained to people how to make risk assessments. One of the things that I often say to my clients is, if you do have a tick box, that's absolutely fine, because you're leading people, a set of questions that have got boxes to tick, that you're leading people through a process. But as part of your monitoring of what they're doing, have a check and see if they made the right risk assessment based on how they answered the questions. Because I certainly know from talking to some of my clients that in CDD teams that they do get lawyers in touch with them quite often, asking what shall I assess the risk at. And as I say, on audit, you can often find that people are just ticking boxes. I know a lovely story from, I think somebody who's on today, who once told me about a tale of someone rang him up and said, I don't know how I've ticked the boxes wrong, but it's told me to speak to you, as if there was some secret formula for ticking the boxes right to get through the file opening process. So, if you're thinking that kind of thing's happening, then go and what I say, calibrate their decision making, see if they're making the right decisions. So next on to source of funds and source of wealth. Now, I think lots of firms struggle with this, mainly because there's no kind of defined matrix for carrying out these activities. Of course, the first thing to say about it, when it comes, well, all clients, but including corporate clients, you may have corporate clients that simplify due diligence, but ultimately you're going to have to make a risk assessment in relation to how much you need to look for source of funds, source of wealth. Now, when I talk about this risk assessment, the questions that you'll be asking to determine the extent of your source of funds, source of wealth inquiries could well be the same questions you asked to decide how many pieces of identity documents you were going to get or which companies you're going to investigate. So, it's something about potentially linking your assessment of high, medium and low, or high and low, to the extent to which you'll do source of funds, source of wealth inquiries. Of course, if we look at the legislation, we do know that we're quite firmly pointed in the direction of extensive source of funds, source of wealth inquiries if we act for a politically exposed person or a client or a counterparty who's established in a high risk third country. And so if you're at that end of the scale, you're probably going to want to see proof of the source of funds and source of wealth, aren't you? Because the regulations require you to do that enhanced due diligence in relation to those kinds of matters. But if you're not in that situation, you're going to have to make a decision about what to ask for. So here's where it's really important that you've made a risk-based decision and you've written it down. One of the things that I quite often say is, in compliance, we look for evidence of things being written down, and we assume that if it's not written down, you've not done it. So this goes back to the last slide, was making sure that you have given your teams the opportunity to make a risk assessment in relation to how extensive should their source of funds and source of wealth inquiries be, and critically, after they have made those inquiries, that they write down whether those documents present any additional risk. So is their assessment of risk still the same after they've seen the source of funds, source of wealth, or has it changed? Because in reality, what I'm talking about here is that you're going to probably ask people to get certain amounts of information. That could be looking at the financial information on Companies House. It could be downloading the audited accounts if there are any, or asking for the unaudited accounts from a corporate client. It might be asking your client about what they do and how they make their money. Now, here's the interesting thing I found when I talk to corporate lawyers. I sit down with them and I ask them the same thing every time. I say, if I pick up your file tomorrow, will I be able to see that you've understood the purpose and nature of the business relationship, including the source of funds and source of wealth? And what do you think the answer is? Well, I'll tell you quickly. The answer is no, you won't be able to see it on the file, but they do know. And of course they must know, because for many corporate clients, they can't advise a client unless they understand the purpose and nature of the transaction, where the money's coming from. You know, if there's an element of banking finance in the deal, of course they will understand, but the challenge is we can't prove that they thought about it unless they write it down. So they will have asked questions about it during exploring the instructions. So it's about providing them with a place to write that down for compliance people thinking about how do we facilitate them proving that they've done it. And you may have heard me talk about before having a 3-stage risk assessment for that reason. 1, to determine the level of due diligence you're going to do. 2, after you've got all the CDD information in, whether that's Companies House information, you know, ID and V information, or whether that's source of funds, source of wealth information. You know, box number 2 should be a revisit of your initial risk assessment to demonstrate that you've looked at all that information after you've got it and you're still happy to proceed. Now, I always get asked, do we have to see bank accounts? Well, you see, bank accounts not the whole answer, you know, and it will largely depend on your relationship with the client. Sometimes it might be helpful to see a bank account and to see the activity. We've seen very clearly in today's session how helpful that would be to you, to give you confidence that the business is trading in the way that they say they are, because you'll be able to see it in the bank accounts, or alternatively be able to see that they're not in the bank accounts. But it's not the only way you can get that information, of course. Obviously, if you're dealing with private individual clients, that's probably the way that you're going to go. But it does require you to take a risk-based approach. I think that one thing that I would say is my experience of the regulator. So if you're a law firm and you're SRA regulated, or you're a licensed conveyancer, so you're CLC regulated, you know, the regulators are moving much more now to focusing on source of funds, source of wealth. And that's not for nothing. It's the right place to look. We do not prevent money laundering by looking at passports and utility bills or incorporation documents of companies. We identify money laundering by seeing that the person's trying to use you to move dirty money. And so if you do feel that this is an area of focus for you, I would encourage you to sit down and think about how you're going to be evidencing that people have made the right decisions in relation to source of funds and wealth. So moving on to the last point, and this is kind of strand 3 of my 3-part risk assessment, which would be your ongoing risk assessment, your ongoing monitoring. Now, ongoing monitoring kind of falls into a few different kind of considerations. There's ongoing monitoring of a client relationship, so the next time you open a matter. There's ongoing monitoring by way of updating the CDD, and then there's just ongoing monitoring generally of the business relationship and the transactions that you're doing. So taking the first one, as I said at the beginning, Regulation 2812A2 says the ways in which somebody's regulated complies with the obligation to carry out client due diligence includes an assessment of risk on each matter. So if you haven't already got matter risk assessment processes in place, I think you need to think about it. Certainly people need to be addressing their mind to, is this a transaction which is typical for this client? Is this a transaction that doesn't make sense? Has the identity of the client changed? Are there different risks posed by this particular transaction? Maybe it's the counterparties or the type of transaction that presents different risks. So you want to make sure you've made that assessment. Remember, if it's not written down, we don't know that you've done it. The second thing I think that we should focus on is your updating client due diligence. Of course, what we know about how criminals operate is that they often present for the first couple of matters completely, legitimate. they look legitimate, they get the law firm's confidence, and the risk is that they then infiltrate the firm. It's after they've got your confidence, your lawyers are confident and comfortable with that relationship. In fact, they're quite committed to that relationship. They'd be worried about losing that relationship if they asked any difficult questions. If you're seeing that kind of thing, you need to think about the possibility of infiltration, because once a client is in, if you're not regularly updating the client due diligence, things could be happening in the background in the beneficial ownership of that client. And if you're not regularly checking, then you might not know that. And what I often see in law firms is that I see policies that say, we will rely on the client due diligence already carried out unless there has been a gap of 3 years in instructions. Now, I know for law firms why you might say that is wording to that kind of is similar to that in the legal sector affinity group guidance. And so it says you don't have to complete client due diligence every time, and you might, might wait until there's a gap in retainers. The theory being that if a client's walked away from you for a couple of years, of 3 or 4 years, then you want to check when they come back that they're still who they say they are in terms of the makeup of their ownership. But if you just think about it, if you've got a client who just instructs you every 10 months, you probably never hit that rescreening requirement in your policy. So you could end up acting for a client for a really long time without having conducted independent verification of what they're saying. And so that's what I say to firms, have a think about whether you really want to do that. Because unless you are working for a client and you're doing all of their legal work, you might not know if the beneficial ownership position changes. In fact, you might be dealing with a client who is owned by somebody, who's owned by somebody, who's owned by somebody. And that client ultimately that's coming in to see you in your office might not have any visibility of the beneficial ownership position at all. And they might not know, so they're not going to be able to tell you. So instead, what I say to law firms is consider instead a shelf life. So the longest time I'm going to rely on this client due diligence without repeating it is this long, so that there'll be a trigger in your system that says that time has passed now, and so we're going to carry out the client due diligence again. And even if you are relying on client due diligence for subsequent matters, I think one of the things you need to be careful of is this risk that something's changed and you don't know about it. Of course, the criminal offence in the money laundering regulations is conducting client due diligence without having, conducting a regulated transaction without having the client due diligence in place. And so I just ask yourselves this. In those intervening matters, how will you know if something's changed? Now, some firms cover that off by putting in their engagement letter, dear client, you must tell me if this changes. But one thing that I've started to recommend to clients is that they think about going back to the client on the next matter, the subsequent matters, or a long matter. In fact, if you've got a matter that's going on for ages, periodically going back to the client and saying, this is what we understand the beneficial ownership position to be. Is it still the same? So not necessarily the whole rescreen exercise, but just checking in that nothing has changed, so at least you can prove that you thought about it. And then the last point I just wanted to cover before we move back to have a chat and take the questions is about sense checking the totality of transactions. So of course, if you're opening subsequent matters, you're going to be doing hopefully a matter-based risk assessment, but it's sometimes, it's quite unusual that firms have got a programme of reviewing the totality of transactions for a particular client. What I'm talking about here is that quite often in law firms, you will find for corporate clients, there will be a client partner that is nominated, somebody who has usually brought that client into the firm, has that relationship with the client. But of course, the name of the game is once the client is in the firm, hopefully we get instructions for lots of different departments for corporate clients, So obviously you might have a client who's onboarded through a corporate matter, who might subsequently have a commercial property matter, who might have a litigation matter or an employment matter. So those clients can pop up all over the place. And one of the weaknesses that I've seen from time to time is that there isn't a communication really with that client partner. There's sometimes an assumption that the client partner knows if things like CDD have changed when the client partner doesn't. There's an assumption that if there was anything to know about this particular client, the client partner would tell you about it, when the client partner hasn't got anything particularly to say in terms of their day-to-day dealings with the client. There are sometimes the situations where there are things that emerge in some of the departments, potentially the litigation type departments, employment or commercial litigation, which are relevant to the client due diligence, but that information is never passed on. What I'm talking about here is if there was a regular review of the client and touching in, with all of the people that are acting for that client, perhaps collating any details about what kind of activity that they're doing, that would, I think, improve the passage of information between people, make sure that everybody knows the situation and any red flags they should be looking out for, and also give the firm the opportunity to think, hang on a minute, this was a small SME client and we seem to be doing, I don't know, £300,000 worth of fees this year, and that wasn't what we expected. Is it because that once they've got in the door, they're starting to use us to launder money? So just that kind of helicopter view of the client relationship, I think we can learn from banking that there are, as well as event-based reviews, there are regular reviews that take place that include that kind of review of transactions that we don't do that often in the legal sector. So I think that's that for me, my slides. I think, Ray, you've got a great model to share with us.
Yeah, absolutely. So Amy asked us to give you some insight into what this whole ongoing monitoring piece looked like in the banking system. So what I'm putting up on screen now is, there we are, look, is the sort of overall financial crime framework model that happens in most banks. And as you can see, that whole top line there, the blue, the mustard colour, and the rather fetching cyan at the right hand side, all of those are
teal.
Yeah, it's a particularly fetching shade, which we often call teal. If you look at that whole top line, that's all about getting somebody in the door for the first time, and banks do that in a very similar way. I won't linger on the individual points there because I know we're keen to get to questions, but there's this whole layer that goes on underneath which continues and starts happening as soon as the approval of the client has taken place. There's a whole realm of monitoring that goes on that looks at activity, that looks at ongoing exposure to things like PEPs and sanctions by continually re-screening. There's screening against adverse media to find out what we ought to know about our clients and about what's going on. And if anything comes out of any of that, if any of those outer reaches of our web, if you like, get a little tingle, then we ought to be doing an event-driven review and revisiting our due diligence, or certainly aspects of it that give us cause for concern. Even if they don't, regularly in a bank we'll undertake a periodic review, and typically in a bank on a risk-based approach, that might be for our riskiest cases once every year or once every 6 months, relaxing down to maybe 2 years, 3 years, or even sometimes 5 years between periodic reviews. But there the focus is not, has anything changed, because I would have known about anything that had changed without having to specifically sit down and ask the question at a fixed time. It's more about, right, let's have another look at the totality of this. Let's look at all we've been doing with this client from the last period and make sure that it still makes sense and that it still presents a coherent picture, and that we're happy to continue with this client for a further period at the same risk rating, or whether we need to adjust or tweak that slightly to reflect any new things that we found. So that was it, Amy. I think that was what you were after, letting people have an insight into that overall model. So yeah, it's probably a good point now to stop talking, the three of us, and go across to George, who I think's probably got a few questions for us.
Indeed I do.